Till now, we have discussed about various issues with regard to fundamental valuation concepts. We have seen future value of annuity, future value of single cash flow, present value of single cash flow, and present value of annuity. Why we have worked out all these things? We have worked out all these things to estimate what sort of returns we can expect, what can be our final amount of our investment which we are doing presently or which we are expecting after certain period of time. This will tell us how our investments can grow based on our expectations of growth on our investments on securities. This particular calculation methodology will help us to understand how our amounts will grow in the future, or what should be the investment we have to make right now to expect certain amount after a certain period. This is why we are calculating future value of our investment based on certain expected returns. Similarly, we are also calculating the present value, the amount we have to invest right now with a certain discounting rate, so that what can be the final amount we will be receiving after a certain period of time. Now, how to expect these returns or interest components on our investments are a very important aspect. The expectation of return depends on the performances of various companies. So, first we have to understand how companies are performing and which is the best company which can give better return. For that purpose, we have to understand the performances, the efficiencies, the strengths of various companies. Now, how do we do that? We have to take the financial statements of those companies and then analyze those financial data and identify the strengths of these companies and also the performance in the past, which can give certain guideline of how the future growth can be and how the security prices also can give us better return on our investment. So, for that purpose, we take the financial statements of individual companies of their past performances, then analyze them. Not only analyze an individual single company, but also we may take a group of companies in various sectors and try to find out which is the best performing company or which is the company which is showing very good financial performance and also better outlook on growth in the future. Based on that, we can bring it down our analysis to one or two good companies where we can make our investment in a proper fashion and get best return on our investment. Now, let us get into these aspects in detail now. Understanding the financial statements of individual companies. In this, accounting is done, which is a system of collecting, summarizing, analyzing and reporting in monetary terms the financial status of an organization. The end product of the financial accounting is the financial statements consisting of balance sheet and profit and loss accounts. All these data will be available on NSE website or on BSE website or many other websites, and even these balance sheets and profit and loss account statements of various companies are being published from time to time in media, print, news, other media. As the name suggests, the balance sheet provides information about financial position of a firm at a particular point of time, whereas profit and loss account provides information of a firm which portrays the flow statement, that is the expenses and revenues, the flows of money, the results of operation over a specified period of time. Usually, the accounting year followed in India is April to March, that is April of this year to March of next year. So what we do is we take the balance sheet, which gives all the details about the total sales, profits, etc., which will be going in detail. This statement belongs to the period April of this year to March of next year. So we take the balance sheet and the profit and loss account for this particular period of a company and analyze them in detail. The balance sheet contains information pertaining to firm's assets, liabilities and shareholders' equity. These are the three aspects which are focused on a balance sheet. Now, on profit and loss account, it summarizes revenue items and also expense items, and also the difference between the two for a certain accounting period. Mere statistics and data presented in this financial statements do not reveal the true picture of a financial position of a firm. This data, which are compiled in a balance sheet as well as in a profit and loss account, gives only a pictorial presentation of the performances of the company. But if we take this particular data and analyze them in a proper fashion, it will give you the efficiency, the strengths of this particular company. So what we do for that? Properly analyzed and interpreted financial statements can provide valuable insight to a firm's performance. To exact or to extract the information from the financial statement, a number of tools are used to analyze these statements. So what are these tools which will be very helpful for us to analyze the data which is provided in balance sheet as well as profit and loss statements? There are three particular tools. One is the comparative financial statements. Two, common sized statements. Three, ratio analysis. So we will now try to use these three tools and find out how we can analyze the financial statements, that is the balance sheet and profit and loss account of a particular company's performance in the past. First, we will get into what is a comparative financial statement. This involves putting statements for two periods or two organizations in a comparative form and indicate differences between them in terms of rupees and in terms of percentages. Now you can see the example 7, the financial statement of XYZ Limited Company for the years 2000 and 2001 are compared in that particular statement. You can see how the equity share capital, the debentures, the current liabilities, land and building, investments and current assets changed or remained same or performed better compared to previous year. So these aspects of this particular company is not only compared in terms of amounts of change for the period 2000 and for the period of 2001. This will give me a comparative statement of how the company has performed with respect to these categories or these aspects of financial performance of this particular company. And the second column in the same statement will help you to understand whether these category of financial performances have improved or deproved compared to previous year. So it gives a clear picture of whether there has been an improvement or deprovement in various financial performances of that particular company. Now let us come to the second tool, that is the common size statements. This involves putting the statements once again for two periods or 2 years or two organizations in a comparative form where items appear in percentage to total rather than absolute rupees or absolute percentages. This indicates relative importance of each item in the total category and significant changes in the composition of these items. Let us take the example 8. Common size statement of ABC Limited Company for the years 2000 and 2001 is given below. Now you can see the equity share capital, debentures, current liabilities, land and building, investments, current assets for the year 2000 and for the year 2001, and the total of all these categories. Now in the second column, where percentages are given, we have seen in 2000 and 2001 how each component of this particular financial statement is having a weightage on the total activities or total categories of the financial performance of these particular companies. If you can see, just for example, the equity share capital has been 23.62% in the year 2000. That means if you see the equity share capital in 2000, it is 15 lakhs, whereas the total is 63.5 lakhs. Fine. Now what is the percentage of this equity share capital as a total setup? It is 23.62% in 2000 for equity share capital. That means the contribution, the percentage of weightage of equity share capital has been 23.62 out of the total assets. Now when we come to 2007, the equity share capital has been 16.17% of the total assets. This indicates the equity share capital has taken certain beat or certain reduction in the percentage of the assets of that particular company. Current assets has been 13 lakh in the year 2000 and it has been 8.5 lakhs in 2001. If you see in terms of the current assets value, it has actually decreased when we compare 2001 data with 2000 data. But however, when we see in terms of percentage of total assets, it has been 41% in 2001 compared to the total assets, whereas in the year 2000 it has been only 13.39% of the total assets of that particular company. This indicates the current asset valuations or performances has been very good, and there has been very good improvement in the current asset percentage status. Let us try to compare current liabilities. If you see the current liabilities in the year 2000, it has been 10 lakhs, whereas in 2001 it is 10.5 lakhs. When we take in terms of percentage of the total assets, in 2000 it works out to 15.75 percentage. In 2001 it works out to 11.32 percentage. What does this indicate? The percentage of liabilities of the company is coming down, whereas the current assets percentage is improving, which is a good sign. Liabilities reducing as a percentage of the total assets and assets improving as a total percentage of the total assets is a very good sign, very good development in this particular company. So such companies are more good for purpose of investments. This is how we have to use the comparative statements or the common size statements to give a clear picture of the financial performance and strengths of this particular company. If a simple balance sheet and profit and loss has been checked, we could not make much of a major changes in the performances. But when we compare 1 year's performance with the next year's performance, then it gives a very clear picture of how the company is progressing, how the progress has been on the positive side or on the negative side. This will give some sort of a idea for us how we can concentrate on which company we can focus our investment, so that we can expect better return on our investments and we can see the future value of our investment or the present value of our investment will grow better when we invest in such companies. Now we will get into more and more analysis of such balance sheets and profit and loss statements. For this purpose, we will get into the third tool,